We have some breaking news. We just had a run on one of the top 20 banks in America. The 16th largest bank, Silicon Valley Bank, has officially collapsed. There was a run on the bank deposits and the feds officially shut them down, which is frightening. It's the largest bank failure since Washington Mutual back in 2008. This bank invested heavily in venture capital firms and startups. Bill Ackman, who was responsible for what is considered by many the greatest trade of all time. He saw COVID happening, he shorted the market, he turned a $28 billion bet into basically $2.3 billion. It was pretty wild. He's recommending that the feds get in front of this and bail out any other banks that are potentially in jeopardy or in danger, because he suggested this could be the first domino and that more banks could fail. In fact, there was a bank in San Francisco today that halted any sort of trading of its stock because of fear that this thing could basically turn into a contagion where it just spirals out of control and there's runs on the bank. This is kind of scary, but there's also some practical things that you can do. So number one, you want to have your money or the lion's share of your money invested in smaller community banks, which seems a little bit it doesn't make sense, right? It doesn't seem like that would be the wise thing to do, but I'll tell you this, the strength of any economy, this has been proven, it really comes down to how many banks they have in a local community. The more consolidation of banks, the weaker the economy is, the more competitive and the more options that we have as far as banking goes, the more strength we have to endure rough times. That's actually been proven statistically. So having your money in a smaller community bank, it's not just better for you from a safety standpoint, it's also better for the economy as a whole, because we're going to be able to weather a lot more storms that way as an economy. The second thing that you could be looking at is hybrid CDs. So these are really popular right now. If you go to a bank, which banks are intrinsically risky, but if you give them a certain amount of deposit, they're going to pay you a certain interest rate. If you wanted any of that liquidity or cash back, you'd have to surrender any interest that you were going to otherwise earn. Well, with hybrid CDs, you can invest them in an insurance company. They're 10 times safer than a bank, maybe even 100 times safer, frankly. But it allows you to have liquidity, so you can take money out even year one if you needed to, and you're not surrendering your interest, and they're paying higher than any bank. So you're looking at 5.4, 5.5 plus as far as a net rate of returns. Very, very powerful. And then number three, you want to be invested in solvent institutions. So banks, because of the fractional reserve banking system, for every 10 cents that they have in the vault, they're allowed by state and federal law to lend out $1.40, right? So if you put $1 million in the bank account, they're creating $14 million worth of loans, and car loans, auto loans, home loans, credit cards, etc. But the point is that fractional reserve banking is intrinsically risky. Did you know that since 2008, 22% of banks across America have had to be bailed out, merged, or acquired? Almost one, in fact, more than 1 out of 5. 1,150 banks in America. So whereas with, for example, an insurance company, where you can get a hybrid CD, they're very solvent. So for every dollar that they have in promises or liabilities, they have to keep $1.09 in cash on hand. So they're the last domino to fall in an Armageddon scenario. What's my point? Guys, this is scary. The market took a massive hit today. It's taken a massive hit the last couple days. And frankly, with what's going on with the interest rate environment, it's looking like inflation is more entrenched than we thought. We're going to see higher interest rates than expected, and it's going to stay that way for longer than originally anticipated, which means very, very likely the market's going to go down another 10 to 20% minimum. And what is that going to do for your portfolio? So now may be the time to check out safer alternatives if you're in that red zone, 5 years before retirement or 5 years after, don't lose a bunch of money in the stock market by procrastinating. So anyway, I just wanted to bring this breaking news. This is huge. Silicon Valley Bank has officially collapsed. There was a run on the bank and the Feds shut them down. Crazy times we're living in. If you have any questions or if you need some comfort, give us a call. We'd love to help you. You guys have a great weekend. Talk to y'all soon.